Hey guys, so I just wanted to talk a little bit about some of the models that I like trading when I'm looking for opportunities intraday. I specifically trade usually just NQ and ES, but this really applies to pretty much any sort of price, any commodity, anything like that. These are ICT concepts, and so they work pretty much universally. So today, what I really want to focus on is the market maker buy model from one of the ICT concepts. And we see it here really clearly on the 8th of February of this year. And it kind of blew my mind, the first time that I really saw this and understood it. And it really makes sense because these things really repeat themselves pretty much every single day. You can always find opportunities like this. They may not be as clean and as clear cut as the one that we saw on February 8th on the NASDAQ. However, these opportunities do repeat themselves over and over again, so you shouldn't really worry about missing out on them. But I just want to bring your attention over here to the start of the day, and these are electronic trading hours. It's not the normal hours, so we're seeing all of the price action that occurs on the 7th through the 8th of February. So right here, we have an area of consolidation. Price is kind of hanging around in this area. It doesn't really know which way it wants to go. And the main thing that we want to focus on here is the targeting of retail buy stops and retail sell stops. So in this instance, we see consolidation from the previous day here. And right here at this top, we see a run on the buy stops above these highs, meaning that there is a pool of liquidity here that smart money is using to match their buy stop orders with their short orders as a way of injecting liquidity into the market. And so when we come up here and we test these highs and we clear these highs right here on the in the previous time of the day, that's an indication or a potential possible opportunity that we can enter short. And we see that actually take place here. We see this area of consolidation. We see a run on buy stops above this high right here, and then consequently we get this drop. And this still isn't the market maker buy model yet. This is still taking place. And so when you're looking at the market maker buy model, you can actually trade both sides of it. You can trade down to the pool of liquidity that we're aiming for, and then you can actually trade the buy side of it too. And when we're focusing on the market maker buy model, this is the entire buy part right here. This whole consolidation into selling, reaching for a liquidity pool, is the sell part, the initial part. And you can actually play, this entire day. And there's opportunities throughout the day that you could take to make a profit. And so what I really want to outline here is we have this initial area of consolidation. We get a run above these old highs, allowing for smart money to begin taking their short position as retail is exiting their long yeah, their short positions because of a run above these above this high right here where a lot of the buy stops are going to be. And then once we get a run above that high, we see price show a willingness to want to move away from that. And that's really important because we need to see price wanting to show a willingness to move away from an area of consolidation in order to formulate a thesis on what we think price is going to do in the future. And so we see a rundown here, a willingness to go lower. We get a small little retracement right here until we get more expansion to the low side. And what I really want you guys to focus on, or what I'm going to focus on specifically for today's video, is this right here. This is picture perfect. It's literally like the cleanest. Once you realize, what we're talking about here and how these market maker buy and sell models are actually coded algorithmically, your eyes will pop. It'll be like you feel like it's illegal knowing the information that you do know. And so what I really want you to focus on right here is we see a drop into a previous area of liquidity. These lows right here are essentially being run out so that we can gain liquidity in the market to push price higher. That's kind of the algorithm that market makers are using. And so right here, we see a drop down into this area of liquidity. And what's really important here is we see this first initial low, we see an area of consolidation, and then we see this second lower low. Now that's really important because for a retail trader, they're going to look at this as a continuation of a downtrend, but that's not what this is. This is simply a turtle soup. And so, if you don't know what a turtle soup is, it's basically just a run below an old high or a run below a previous old low, where there's a reversal, and then we see a reversal afterwards. So right here, we see a turtle soup formation. We see a low, we see area of consolidation, and then we see a lower low. And notice how the wicks do the damage here. You see how the bodies of the candle are all closing above this area right here, above these lows. That's a pretty good indication that we're actually going to go higher, and this was just simply a raid on sell stops in the market. And so right here, it's 8:30 a.m. New York time, so 5:30 a.m. for my time. And we see a run below these old lows. And at this moment, there still isn't any specific trade setup yet if you're not really conditioned to understanding what turtle soups are. So you might see this happening in real time and might think that it's going to go lower. The advanced ICT trader is going to understand that this is simply just reaching for these lows and that we're going to, continue to go higher afterwards. Um, but let's say you don't get a long entry here in these wicks down here because you can't really tell if this is a turtle soup or if we're going to see a continuation to the downside. What's really important, what I really want to get you guys to pay attention to, is this volume imbalance right here. So the way that market makers make their money is they basically scrape pennies off the dollar, like fractions of pennies off the dollar, for matching buyers and sellers in the marketplace. And so when we see a gap like this is technically actually a volume imbalance. It means that price wasn't efficiently traded in this range, and there's a willingness for market makers to want to bring price back to that level, specifically for the fact for running their books. They want to make the most money out of it as they can in the market, and they're attempting to make sure that every single point that we trade at, every single tick, is efficiently traded price. And so when we see a large gap like this is inefficiently traded price, and we can use this actually as an expectation for future price action. And so when we take everything into context here, when we have this low, and then we see a lower low afterwards, and then after this lower low, not only are we closing above these wicks, like the candles aren't closing down here, they're actually only the wicks are, going through, and then we're actually closing up here. It's a really good indication that we're going to continue to go higher, and we actually do see that. We see a continuation up. We see a willingness to want to move away from this price level. And so this wick right here is really what I want you to pay attention to. It comes in at 940. This is the 5-minute chart. And on like the 10-minute chart, this is pretty much just shown as a fair value gap. Which if you don't know what that is, definitely go study ICT concepts. That's the best way to trade. Um, so we see this lower low here. We see a willingness to want to go up. 9:30 is the one when the market opens. There's an injection of liquidity at that specific time. We're not looking at indicators. We're looking at price and we're looking at time. And where there's injections of liquidity, whether it's 5:30 a.m., 6:30 a.m. That's for me at least. I'm on the West Coast. We're seeing times where the market is injected with liquidity. You have to understand that this is an algorithm that we're trading off of. And so we see this lower low here. We see a willingness to want to run up higher. As soon as you see something like this, where you see this low taken out right here, and you see the wicks are closing inside of the bodies of the candles over here, and then we see a willingness to want to go away. If you look really closely, you can almost always see either a fair value gap, or in this instance, a volume imbalance to where price is going to want to trade back into before continuing higher to take out the pool of liquidity above this area of consolidation here. And so with that, if you look exactly like, and I mean exactly to the point where the candle closes here, see the opening of this volume imbalance, or the bottom of this volume imbalance occurs exactly at 803, 17803 big figure, and we see this wick come all the way down to sorry, one sec. Oh, sorry, I was looking at the wrong figure. This is 17808 big figure is where the candle closed. This wick comes exactly down to 17808. It's right here at the top of the screen. I'm pointing like an idiot. But right here, look at this number. The opening of or the close of this candle is 17808 right there. 17808, and the low of this candle is 17808. This is algorithmic theory. This is perfect price action. We see market makers want to rebalance price to come to this point before sending it further. So if you're not able to get an entry here and you see something like a volume imbalance here or a fair value gap forming in terms of a market maker buy model, then you can actually use that as an entry. Now, you have to remember that these volume imbalances and fair value gaps, they show up all the time, but you have to understand which volume imbalance and which fair value gap that actually matters. And the ones that matter are when it comes to a model exactly like this, where we see a market maker buy model, we see an area of consolidation, then we see price want to move away from that area of consolidation, and then we see a turtle soup buy right here. This turtle soup buy is really important because it shows us, stability. Like we're not going to keep going lower at this point right here because we've already taken that sell side liquidity right here. once we've taken this sell side liquidity, we're not going to go back and further take sell side liquidity because our draw on liquidity is up here above this consolidation. And the way that figure that out is basically just doing higher time frame analysis and looking at PD arrays on the higher time frame. Um, and so this instance is literally a perfect example of a market maker buy model. And sometimes, like I said, they're not going to come as clean as this. But when we see price have an area of consolidation, move away from that, we see a turtle soup buy here, and then we see something like this. This is gold. We see this volume imbalance, or whether it's a fair value gap volume imbalance. This is a volume imbalance, as of it's what's shown in the chart. And so when the market opens and there's an injection of liquidity, we can use that as a target for future entries. And so that's exactly what we saw. And the fact that it's to the pip perfectly kind of shows the value of what I'm teaching you here. It's not even like, maybe if even if it goes a pip over the close of this candle, which is 808, that's still fine. Our model allows for that. But the fact that it goes straight to the pip and then goes absolutely crazy. It rockets all the way back up. It shows the value of ICT concepts and how we see it literally happening every single day in the marketplace. So yeah, I hope you guys learned a lot from this teaching here. There'll definitely be more to come. But I just wanted to outline one of the models that I like trading, something that I am always looking for when I'm day trading, indices or futures. And it's really valuable if you understand how price really actually plays and understand what the interbank price delivery algorithm is actually telling you. Then you can actually use that to frame your day trades a lot better. Because if you don't understand these models, these market maker buy or sell models, and you're basically just trying to enter in willy-nilly off any fair value gap or any volume imbalance, you're going to get stopped out and it's going to be a rough time. But if you can find this model and see it happening real time, and then use that as a basis for entering off a fair value gap or entering off of a volume imbalance, which is one of the weakest PD arrays. You don't always want to enter off a volume imbalance. But that is how you build higher probability day trades. Like if this what didn't exist, and if this volume imbalance was just there and there wasn't this whole turtle soup buy scenario and this area of consolidation here, then it's just any other volume imbalance and those can get traded over like easily. You know what I'm saying? But the fact that we have this model, we have a setup, we have a framework for our trade idea, it improves the odds of this trade actually working out in our favor tremendously. So yeah, that's all I wanted to teach with you guys today. And obviously, if you're entering long here, then you're going to exit at this, pool of liquidity up here. You don't want to keep holding. You want to take profit along the way. And that's how you get more consistent with your day trades. And hopefully you guys can make some money and, learn a little bit from this. So yeah, thanks so much.